super excited to welcome you to Piper Trading Academy. In this academy, we've started ourselves with the responsibility of taking free forex course from beginner to professional, from being a beginner down to professional. So we have a couple of series that we'll be going over. In this particular series that we name Learning Forex Trading from Scratch, in today's episode, which is the episode 1, we'll be going through introduction to Forex, basics of Forex trading, trend, market structure, fundamental analysis, technical analysis, and sentimental analysis. Without any delay, let's go into what introduction to Forex is. What is Forex market? As we all know, we used to hear the word Forex. What does Forex really mean? Forex is just an abbreviation for the word foreign exchange. That is exchange of currency from one country currency over another country currency. So exchange of foreign currency. That's what Forex is all about. So the Forex market is said to be a global marketplace for exchanging national currencies, just like I said, exchanging one particular country currency against another country like the UK and the US. It's British pound, while US is the US dollar. So exchange of GBP against the US dollar. So Forex market is the largest and most liquid asset market in the world. No market is as big and liquid in assets as the Forex market. So next in line, if we look at any Forex market chart, first thing that we will see, that is most likely for us to see, is a candlestick chart. If you don't see a candlestick chart, probably a line chart or a bar chart, but the one that is most commonly used by everyone is candlestick. So what is candlestick in Forex market? A candlestick chart is a style of financial chart used to describe price movement of a security, commodity, or currency. So as it is, we know that our focus in this particular course is based on currency. So we won't be talking about security or commodity in this particular series that we are doing. Our main focus is on currency. So we said a candlestick actually denotes or describe price movements of the currency. So in each candlestick, there are 4 important pieces of information, which are the open and close of the candlestick, which lies in the body of the candle, while high and low in the candle wick. What this really basically means is that from this open of this candle here down to its close here, this whole region that is filled, this is where we call our candle body. So in this part that is labeled upper shadow, we can see that above the wick, that's where our eye of the candle is, while this lower shadow part, that's where the low of the candle falls. So in each candlestick that you see, these 4 important information is shown to us in each candlestick that is on the Forex market chart. On any currency pair, each candlestick shows these 4 information: the open, the close, the high, and the low of that particular candle. So types of candlestick that we have the bullish candlestick and the bearish candlestick. The bullish, let's talk a little bit about the bullish candlestick. A bullish candlestick is the candle representing buyers in the Forex market. It has its opening price below its closing price, while its high is the top of the wick above the closing price, and its low falls on the wick below the opening price. So as it is being said in the definition that we gave to a bullish candlestick, that it represents buyers in the market. And in Forex market, when you are buying, we expect price to be going up. So that is why if you look at this candlestick diagram that we have here, for a bullish candle, we have its open price below, while its closing price is above. That is, the buying started from here, started from this opening price, so started moving up and close here on the body. This is the candle body. This green portion here is the candle body. So we have the high above the wick and the low below the wick that is below. So each bullish candlestick represents buyers in the market, and opening price is always below the closing price. The high and low is at the wick. So if we are to talk about bearish candlestick, a bearish candlestick is a candle representing sellers in the market. It has its own open price above its closing price, and the high is on the wick above the opening price, while the low falls on the wick below the closing price. You see, both the highs and the low doesn't change, but you see the difference between a bullish candlestick and a bearish candlestick is the opening and the closing price. For bullish candlestick, the opening price is always below while closing price is above. But for a bearish candlestick, the open price is always above while the closing price is below, because we say it is said to be that bearish candlestick represents sellers in the market, and when the market is selling, we expect it to be falling, so price should be coming towards the downside. So that's why we have the opening of this bearish candlestick on the top while the closing price is below. We have what we call base and quote currency. A currency pair is the quotation of two different currencies, with the value of one currency being quoted against the other. The first listed currency of a currency pair is called the base currency. Second currency is called the quote currency. So as it is, when we started, we said forex markets is the exchange of foreign currency, that is a particular country currency over another country currency. So now we have what we call base and quote currency, right? For you to have in a currency pair, that is a particular currency against another currency, that's the currency pair. So the base currency is the currency coming first on the listed currency pair. Is the That is, as it is now, we have an illustration below here. GBP GBP simply means Great British Pound. That's the UK currency, the United Kingdom currency. So that's the pound. So it's the one coming first in this currency pair. That is why it is the base currency. That is the currency coming first. While a quote currency is the currency being paired with the base currency. What this simply means is that the base currency must be greater in any which way the currency pair wants to come. The base currency must be greater than the quote currency. If we look at exchange rate of pound to dollar now, we'll be having around, for you to get £1 in US dollar, you need at least 1.07 and some figure to get 1 GBP in the forex market. So the base currency must be greater than the quote currency. So that's for base and quote currency. We have the forex broker. A forex broker is a financial service company that provides traders access to a platform for buying and selling foreign currency. What a broker is just this financial service company that provides we traders the access to a platform where we can actually place our buying and selling. It's just like the marketplace for a medium that we use to access the market, a platform that we use to access the market in order to place our trade. So we have examples of forex broker that we've tested over the years: IC Market, Google's Way, Pepperstone, Ohanda, FXCM, TO Market, Black Bull, FBS, XNES, and Infinite. Here we have PIPS. What is PIPS? PIPS is an acronym for percentage in points. A pip is the smallest whole unit price move that an exchange can make based on forex market convention. What a pip is: a price move in a particular direction for a couple of ticks, like for a couple of points. That particular point that it's moved is what we calculate as pip. So if you look at this value of the pound against the US dollar, that is, if we are going to buy one, if we are going to be getting £1, we need at least $1 $1.18752 to get £1. So when we look at this in pips calculation, in a currency pair like this that we have a single whole number before 5 decimal places, so the way we calculate pips on this one is different from a currency pair with three whole number before the decimal point, before the decimal number, before numbers coming after the decimal point. In a currency pair like the CHF JPY, that is the Swiss francs against the Japanese yen. So we are going to do a particular video that will be able to explain more on all of these things that we've been talking from the beginning. This is just an overview of what forex trading really looks like from scratch. So we are going to do some intensive videos that will explain more about all of this. I just want you to have an insight. It won't be new to you when you see those videos coming out. So as it is, we have what we call pipite. Pipite is half of a pip, is not up to a pip. That's what pipite means. So as it is, this first number here, after these 5 decimal points now, this first number coming, this 2 here, you can see I label it as 0.2 pips. That it is not even up to a pip. That's why I arrowed it out and name it pipite. That is, half of a pip is the pipite. So if we look at it, our pip actually started counting from the second number, which we have 5 as the figure there. So that's 5 pips. 7 here, we have 70 pips. 8 here, 800 pips. The 1 here signifies 1000. That is, if there is going to be any change in price here, if there is any change in this current price that USD is actually trading on, at it being we have, okay, 1.18552. So if we are going to calculate what is the pip difference between this 1.18752 and 1.18552, that should be around 20 p. We are going to do some intensive videos that is going to explain more about all of this to us. We have what we call spread. Spread is the difference between the bid price and the ask price for a currency. That is, the price at which you want to sell, the price at which you want to sell and the price at which you want to buy. The difference between the buy price and the selling price is what we call spread. Spread is actually part of what brokers use in making their own money. Like brokers that doesn't charge for commission, they use a bigger spread. So we have what we call ask, like as it is said in the spread definition. We said spread is the difference between the bid price and the ask price. So what is ask now? Ask is also the same thing as offer. It's the lowest price at which you are willing to buy a currency. So that was why I said the difference between the buy point and the selling price. That's what we call spread. So for ask now, ask is the lowest price at which you are willing to buy a currency. Why bid? Bid is the price at which you are willing to sell a currency. In forex trading, it is not possible for us to trade any currency against each other directly, like we saying, okay, we want to trade $1 for £1. It is not possible. So we trade in forex trading with lots, with what we call lot size. It's lots. So your lot size now, currency are traded in standard size known as lots, as just like I said. Okay, there are four common lot size. We have the standard lot, the mini, the micro, and the nano. This nano now doesn't really come up among brokers in forex market. Where we will see nano more is synthetic indices. That's, I think the broker that offer nano is Deriv, yeah. They are the one that offer nano. But what you will see on most broker is the standard, the mini, and the micro lot size. The choice of lot size has significant effect on the overall trade profit or loss. That is, the bigger your lot size, the bigger your profit if the trade goes in your favor. But the bigger your lot size, the bigger your loss if the trade goes against you. And the smaller your lot size, the smaller your profit if the trade goes in your favor. The smaller your lot size, the smaller your loss if trade doesn't go in your favor. This diagram below here only show, if you look at it, we have the column for standard lots, we have for mini and micro, but we don't have for nano. That is what I'm saying, that most broker doesn't offer nano lot size. Where you will see that is on synthetic indices like the volatility index on Deriv offers nano lot size. Okay, let's move on. What is leverage? Leverage is the use of borrow capital to multiply return. It can also be said to be the buying power that a trader has. As it is, leverage is given to us by, is offered to us by our brokers. That is, if you are actually registering on your broker platform, I think for US they have a regulated um leverage that each broker can offer. I think it's from 1:50 leverage. That's what they are offering. But some other part of the world, some other countries, brokers offers 1:50, 1:100, 1:200, 500, and 1,000. So that is, if you have $1,000 in your account and you are using a broker of 1:50 leverage, are you getting? So your 1,000 multiplied by your 50, you have capacity of buying more than the $1,000 you have in your account. So it's just like broker borrowing you a little capital, so for it to multiply your return on each trade. And the same thing goes to, if you lose on that particular trade, you will be losing more. Is the same way you are gaining more, is the same way the loss will be multiplied. The way they are multiplying your return, they borrowed you capital for you to trade, so in order to multiply your return. So it's the same thing that happens if trade goes against you. So what is margin? Margin is the money set aside in an account for a currency trade. Margin money helps assure broker that the trader will remain solvent and be able to meet monetary obligations even if trade does not go their way. The amount of margin depends on the trader balance over a period of time. At times you might hear people saying, oh, they are taking a trade with full margin. What they simply mean is that they are risking their entire account on that particular trade, like 100% of their account on that particular trade. But on a trade whereby you maintain a risk management, you will observe that your margin percent will be calculated. You'll be seeing your margin percent on your broker platform, that okay, this is your margin. Don't worry, we'll talk more by using video to explain more of this, so so that we can understand most of these very well. So let's move on. We have order. An order is an offer sent using your broker trading platform to open or close a transaction if the instructions specified by you are satisfied. That is, when you place an order, maybe an order to buy or to sell, once that order is fulfilled, so definitely we can call it an order. Like once that particular transaction is fulfilled, whether be it a sell order, be it a buy order, once it is filled, then we can call it an order. In another word, order refers to how you will enter and exit a trade. That is, if you have a buy order or a sell order, the way you are willing to enter into the trade and the way you are willing to exit, be it in profit or be it in loss. So we have types of order. We have the major type of order that we have is just two. Again, we have the buy order and we have the sell order. But the buy order is further classified into buy limit, buy stop, pause, and sell limit and sell stop. Though we have order that is market execution, that is not pending order. All these buy limit, buy stop, sell limit, sell stop, all these are pending order. We have market execution, that is you be buying. If you are buying on market execution, that is you are buying at current market price. That's for market execution. But for buy limit, buy stop, sell limit, sell stop, they are orders that you place that will be filled later, not immediately. So let's talk about the types of orders that we have. Let's talk a little bit about them. So for the buy limit, a buy limit is a pending buy order placed below the current market price. I get it. Like it is now, I use this little image just to depict what I'm actually talking about. So we see where is labeled as CMP. This simply means current market price. So the order that we placed is represented by this horizontal bar below here. So current market price will be above while the order will be below. A buy limit is a pending order placed below the current market price. That is, we are anticipating that okay, this is the level at which I want to buy from. I'm not buying from the current market price. I want price to come a little bit cheaper for me to buy from here, because in the regular saying of forex trading, they used to say sell high and buy low. So you want to buy at a favorable price for you. You want to buy at a favorable price, at a price that you see that it's favorable to you. So for buy stop, it's the pending buy order placed above the current market price. Okay, that is, the current market price is way below, but you are contemplating, okay, you want price to, it is an order that you place above the current market price. So once price wants to continue going up, that price wants to continue buying, your order will be triggered while price is coming up. So that is for buy stop. For sell limit is a pending sell order placed above the current market price. That is, it is a point at which current market price is below, so you want to sell high, so you place your sell limit above current market price at a price that seems more favorable to you. So sell stop is a pending sell order placed below the current market price. That is, the current market price is a bit higher, so if you are placing a sell stop, you'll be placing it below the current market price. So if if market wants to continue selling, your order will be triggered along the line and be filled. That's for the depending orders that we have, which is buy limit, buy stop, sell limit, sell stop. We have what we call stop loss. What is stop loss? A stop loss is set up to automatically close a trading position within the trader risk profile. It's a defensive mechanism that can be initiated to protect an order against deeper losses. That is, A stop loss, when you have a position, a trade place, be it buy trade or sell trade, you have your stop loss on. That is, even if the trade goes against you, your stop loss is set there automatically, that once price should go against you to that point, you should be taken out of that trade. You are accepting that loss and you are leaving the trade. That is, you don't want to lose more than what you risk. You don't want to lose more capital from aside the one you've identified to lose on that particular trade. That is, the stop loss, once it is hit, your trade automatically close in loss. It's just like a defensive mechanism to protect your capital from further losses. Just to protect you, to protect your capital, your trading capital, from deeper loss. Same thing goes to take profits. Take profits is set up to automatically close a trading position once in profit. That is, when a profit target is set and price, you are in a position, whether you are buying or you are selling, and you've set your take profit target. The take profit target is just a place where you feel, okay, the money you've made from the market is, you are satisfied with it. So this is just for you to lock in profits that you've made. So once you set your take profit and price gets to your take profit level, the trade will automatically close and lock in your profit for you. So we have sessions in Forex. Sessions is the primary trading hours and locale for a given asset. The sessions are divided into three, namely Asian session, London session, and New York session. That is, there are other sessions too in the market, but the significant session in the market is these three that we mentioned. We have Frankfurt session 2, is between Asian and London session. Frankfurt happens to be between Asian and London, but the major session that we need in Forex, that we need to be profitable in Forex, are just these three main sessions, because it is during these three sessions that you will see active traders in the market. During Asian session, there is no much volume, there is no much going on in the market. But during London and New York session are those major market hours that you will see a lot of movement in the market, because that's where we have active traders, both active traders, both those that want to be buying, those that want to be selling. London session and New York session is where you will see much movement, much volume in the market. So according to the Greenwich Mean Time, the GMT, Asian session is between 11 p.m. and 8 a.m. London session falls between 7 a.m. and 4 p.m., while the New York session happens to be from noon down to 8 p.m., just as seen on the PDF. So we have what we call psychological level. Psychological level represents strong price level denoted by round numbers, that is O number, or multiple weeks or month high or low price level. That is multiple weeks high, like a week high, monthly low, monthly high. The psychological level are those particular levels represented by O numbers, round number. Okay, in the case of Euro, USD, this is the currency pair now, the euro against the dollar. So we have 1.3100. This is a multiple of 100. We have 1.3200. The difference between 1.3100, the pips difference between 1.3100 and 1.3200 is 100 pips. So I'm just saying this so to enlighten you a little bit more on what pips different looks like. So we have 1.3300. These are psychological level that we believe that when price get to these levels, there should be some sort of reaction. It's either they serve as support for price or they serve as resistance to price. So some may even go some step further and look at the numbers that fall in between the psychological level of hundreds. So those are the number that we call the 50s. So people, some people do their psychological level based on difference of 50-50 pips. Are you getting it? So in multiples of 50-50 pips. So as it is now, we have 1.31500. The difference between 1.3100 and 1.31500 is just 50 pips. So some people do their psychological level in multiples of 50 pips. So we believe that those psychological levels are levels that price needs to show some reaction, even if they are not going to hold price later on, but there should be some reaction. There are valid areas that you can be looking to take a trade from. So talking about analysis, we have three major types of analysis. We have the fundamental analysis, sentimental, and technical. Fundamental analysis is a way of looking at the forex market by analyzing economic, social, and political forces that may affect currency price. In simple word, the word fundamental analysis is just the way we look at economic events such as news, release, political forces, social talks like important people, social talk that can affect that can affect the market or a particular currency. If there is an economic event, that is a news release coming on the US dollar, we expect some reactions during the important news release, not just any news. There are some certain news that are important. Like for the US dollar now, we have news like the FOMC, we have the NFP, that's the non-farm payroll. We have the GDP, unemployment change, interest rate decisions. So all those kind of economic events are what we look at when we are analyzing fundamentally. Those are the categories of things that falls under fundamental analysis. So when we talk about sentimental analysis, when we talk about the word sentiment is just the way we perceive, like our own view. So now sentiment analysis is used to gauge how other traders feel, whether it is about the overall currency market or about a particular currency. So the way we think, okay, my own sentiment about this market, okay, I feel this market will be buying, no, I feel this market will be selling. Other traders too should be feeling, probably should be buying or selling. So that's what sentiment is. Like being sentimental, okay, this is what you are sticking with. You don't have any other analysis, you've not done any major analysis on the chart. What you just feel like, okay, this market should be buying, is just what you feel. That's what sentiment analysis is. So for technical analysis, which is the most important type of analysis, to me, I don't know, there are people that are more comfortable using the fundamental analysis to trade, but for me, I believe technical analysis is more effective. And so technical analysis is the framework in which traders study price movement. The theory is that a trader can look at historical price movement, that is price movement that has happened in the past, previous price movement. It might be years back price movement, it might be some months back price movement, past price movement on days, week, even hours price movement, and determine the current trading conditions. That is, we can use the past data that we have to determine what current market is actually doing and potential price movement. So from past data, from analyzing the past data, looking at considering the current market condition, we can forecast into the future potential. That's what we mean by potential price movement. We can forecast into the future that, okay, with what has happened in the past and what is happening right now, this is what is most likely to happen next. So that's why I said technical analysis is the most effective analysis that you can do, because it has more information that you can actually interpret. So you can look at past data to help you spot trends and chart patterns, which could help you find some great trading opportunities. So technical analysis is just is the main deal when it comes to analyzing the forex market. So let's move on. We have what we call trend. A trend is a tendency for prices to move in a particular direction over a period. Trend can be long term, short term, upward, downward, and even sideways. That is, it is a price movement in a particular direction. You know, when we talk about, okay, something is trending, that is something that almost everybody is actually doing. So in the forex market, what we mean by trend is when price moves in a particular direction. It might be in upward direction, it might be downward direction, it might be sideways. So a trend can either be long term, a trend can last for months, weeks, years. A particular trend can last for long term, and it can also be a short term, because when we look at price and we look at the chart, whatever is happening on the 1 hour time frame, the same thing is also going to repeat itself on the 4 hour time frame. Likewise, the daily time frame, the monthly time frame, the weekly time frame. We have lower time frame trends. Trend might be happening. We might have a particular trend on 15 minutes time frame. Meanwhile, it is not a visible trend on the 4 hour time frame. So that's why lower time frame are more likely to give us more short term trend, unlike the trend coming from the weekly, the monthly time frame, or the daily time frame. So that's where we can have a long term trend. So we said a trend can either be upward trend, downward trend, and even sideways. Let's talk about the types of trend. We have the uptrend, it's also known as the bullish trend. We have the downtrend, also known as bearish trend. We have the sideways, also known as ranging. Still the same thing as consolidation. So when we talk about the uptrend, which is our bullish trend, in a bullish trend, we have the formation of higher highs and higher lows. On closer inspection, one will notice that each top is higher than the previous top. That is, this point that we have the higher high. If you look at it from the previous higher high, it is higher than that high. That's what we mean by, we will notice that each top is higher than the previous top, and each bottom is higher than the previous bottom. If you look at where we have our higher low on this diagram, where we have our higher low, those low are higher than the previous low, the previous bottom. So in a bullish trend like this, we will be having more of buying opportunities. You can see that it's not that market is not selling, but the sales that we'll be having in that particular trend, we call them retracements. Don't worry, we'll go in deeper on videos that will be explaining more about each of these. We already said it, this is just an overview of what forex trading actually looks like. So we have the downtrend, which is also the bearish trend. In a bearish trend, we have the formation of lower highs. You know, during uptrend, the formation is higher high, higher low. But in a bearish trend, the formation is lower high, lower lows. On close inspection, one will notice that each top is lower than the previous top, unlike the bullish trend where each top is higher than the previous top. In a downtrend, the previous top, each top, the new top formed is lower than the previous top. Each new top that the price is forming as it's going down is lower than the previous top, and each bottom is also lower than the previous bottom. But for bullish trend, each bottom is higher than the previous bottom. But for bearish trend, each bottom is lower than the previous bottom. As you can see, we have this point of lower high, then lower lows, lower high, lower lows, lower high, lower lows. This is a downward trend. In this condition, we can say that okay, this market is actually moving towards one particular direction, which is the direction of the downside. So we have the sideways trend, which is also deranging. In this type of trend, we will notice that there is no creation of any new significant highs or low. Unlike the previous two trends, which is the bullish and the bearish trend, we have creation of new highs, new low, new highs, new low. But in a ranging trend, you will see that price will only be moving in a particular range. In a particular range, you won't be seeing any new highs forming, neither will you see any new lows forming. So this is a period of consolidation, and in this period, most of the time is hard to trade. So it is advisable that you should stay out during this period. You only have more trading opportunities during a trending market. So as we said, the price will continue to consolidate in a particular price range until we have a breakout of the range. So once we have a breakout of the range, be it to the upside, be it to the downside, we will see that okay, after the breakout, market will start trending again. So we have what we call the market structure. Market structure, in a simple word, is the highs and low. It is the basic term of analysis. It is the basic form, rather, it is the basic form of analysis to identify the highs and low, the higher high, higher lows, lower low, lower highs with in the market. That is, when we talk about market structure, these are this particular thing is one of the major things we need in order to be successful in forex trading. How to identify our highs, our low, lower high, lower low, higher low, equal highs in the market. This is what market structure actually entails: the identification of highs and low in the market. Within these four basic structure, which is the higher high, higher low, lower high, lower low, that's what we mean by basic structures. You can identify further price pattern like the head and shoulder, double top, triangle, flag, pennant. All this that we mentioned will be discussed later on in this series in another episode. So we should don't let us make this particular episode to be too lengthy. I think with these few that we've covered, we should have insights of, as a beginner, I'm not talking about those are professional already or those are at the intermediate level. I'm talking about the beginners now. With this little video that we've done, you should see that okay, you should have insight of what forex trading is all about. Once again, I welcome you to Piper Trading Academy. In this academy, don't worry, you have a lot to learn for free. All we need from you is for you to subscribe to our YouTube channel, turn on the notification button so you can get notified when we release super exciting new videos regarding this course. So thank you. Have a nice day.